Hello everyone, welcome to the market opening bell on Wednesday, 4th March, your 10-minute guide to the stock market. Hong Kong stocks opened high and closed low on Tuesday. The Seng index opened 130 points higher, rose 159 points in the early session to a high of 26,218 points, then turned downward. In the late session, it once fell to 332 points to 25,727 points. For the full day, it dropped 291 points or 1.1%, closing at 25,768 points. The H-share index fell 93 points or 1.1%, closing at 8,608 points. The Hang Seng Tech index fell 112 points or 2.3%, closing at 4,876 points. Total market turnover was 370.5 billion Hong Kong dollars. Southbound funds net bought $6.081 billion worth of Hong Kong stocks, of which net purchases include Tencent Holdings at 2.559 billion, Tracker Fund 2.343 billion, CSOP Hang Seng Tech ETF 1.413 billion, Xiaomi Group 780 million, Sinopec Oilfield Service 699 million, Shanghai Dazhong Public Utilities 309 million, Shandong Molong 143 million. Net sales include Alibaba at 1.209 billion, Costco Shipping Energy 383 million, Yangtze Optical Fiber and Cable 293 million, SMIC 170 million. According to statistics, Southbound funds have net bought Xiaomi for 8 consecutive days, total 5.978 billion. Tencent for 3 consecutive days, total 4.573 billion. And the CSOP Hang Seng Tech ETF for 3 consecutive days, total 6.575 billion. They have net sold SMIC for 4 consecutive days, total 852 million. The 3 major A-share indexes also opened high and closed low, with losses widening in the afternoon. The Shanghai Composite Index briefly hit the new 10-year high in the morning before weakening and finally closing down 59 points or 1.4%, near the day's low at 4,122 points. The Shenzhen Component Index fell 443 points or 3.1% near the low, closing at 14,022 points. The Chinex Index dropped 84 points or 2.6%, closing at 3,209 points. Turnover on the Shanghai and Shenzhen markets total 3.13 trillion yuan. The renminbi central parity rate against the US dollar stood at 6.9088, up 148 pips day on day, on the highest level since 4th May 2023. The 4th session of the 14th National Committee of the Chinese People's Political Consultative Conference will open at 3 p.m. today in the Great Hall of the People and close next Wednesday morning, lasting 7 days. The main agenda includes discussion of the draft outline of the 15th Five-Year Plan for National Economic and Social Development. Tanker stock Costco Shipping Energy rose 2%. The Baltic Dry Index continued to climb, lifting shipping stocks Oriental Overseas up 2.9% and Costco Shipping Holdings up 5.2%. According to Iranian media, senior advisor to the commander-in-chief of the Iranian Revolutionary Guard, Ibrahim Jabri, stated that the Strait of Hormuz has been closed and Iran will open fire on any vessels attempting to pass. This is the clearest warning since Iran informed ships on Saturday that export routes would be closed. Clarkson estimates that currently 7% of the global crude tanker fleet capacity, 5% of LPG carriers, 4% of product tankers, 2% of container ships and 2% of bulk carriers, 2% of LNG carriers are inside the Persian Gulf. The reduction in compliant vessel supply is positive for the industry, while higher oil production by OPEC Plus countries is driving up cargo volumes. Major operators' bargaining power is also at an all-time high. For container shipping, current geopolitical tensions have only limited impact on supply and demand. However, rising oil prices will exert negative pressure due to higher cost burdens. Although short-term sentiment is positive, the industry is expected to enter a down cycle once the current supply surplus materializes. LNG prices surged, sending Hong Kong-listed gas stocks soaring across the board. China oil and gas skyrocketed 120%. Shanghai Dazhong Public Utilities surged more than 61%, and ENN Energy rose 5.1% to become the top gainer among blue chips. The sharp rise in liquefied natural gas LNG prices actually poses severe challenges for pipeline gas companies, especially those relying on imported LNG as primary or supplementary feedstock, causing procurement costs to spike, gross margins to shrink sharply, and in some cases inverted pricing, selling price below purchase cost. This will force companies to face short-term operating losses and heightened liquidity risks. Lithium stocks Tianqi Lithium and Ganfeng Lithium fell 8.1% and 10.9% respectively. Battery-grade lithium carbonate prices traded in the range of 156,900 to 168,200 yuan per ton, down 11,300 yuan from the previous working day. The price once hit 180,000 yuan per ton in January 2026, but later retreated after the market reassessed energy storage investment demand and export tax rebate policy changes. Global lithium chemicals consumption is forecast to grow 13.5% year-on-year, with energy storage systems and electric heavy trucks remaining the strongest growth drivers, offsetting the slowdown in traditional passenger EV demand. Lithium carbonate inventories remain relatively low, around 109,000 tons, providing fundamental support for prices around 120,000 yuan per ton. Hong Kong-listed mobile phone supply chain stocks continue to decline. AAC Technologies fell over 6%, FIH Mobile nearly 4%, while Q Technology, BYD Electronic, and Highwells Electronics each dropped nearly 3%. Industry sources believe that if memory prices stay elevated, cost pressures will pass through to end products. In 2026, the mobile phone market may see multiple price hikes within the year. Average selling prices of new models in China could rise 15 to 25% compared with the same tier in 2025, with some mid to high-end flagships increasing by as much as 2,000 to 3,000 yuan. Facing such sharp price rises, consumers' first reaction is naturally to delay upgrades. China's average phone replacement cycle has already lengthened to 33 to 38 months, and this trend is expected to intensify under the new price hike wave. Techtronic Industries released its 2025 annual results. Revenue reached $15.26 billion, up 4.4% year-on-year. Gross profit rose 6.7% to $6.292 billion. Gross margin improved 91 basis points to 41.2%, reflecting the positive contribution from high-margin Milwaukee operations, productivity gains, and improved operating efficiency in the Ryobi and other consumer businesses. Net profit grew 6.8% to a record $1.198 billion. Earnings per share were $0.6561. A final dividend of 1.32 Hong Kong dollars per share was declared, up 0.14 Hong Kong dollars. Full year free cash flow was nearly $1.4 billion, leaving the company with $700 million net cash at year-end. For 2026, the company expects core Milwaukee and Ryobi businesses to deliver mid to high single-digit revenue growth, partly offset by the planned exit from the HART business and ongoing rationalization of the floor care segment. It also plans to repurchase up to $500 million of shares over the next 18 months. Technical analysis shows that the Hang Seng Index once rebounded to the 26,200 point level, which can be regarded as a technical pullback after it broke below the 100-day moving average at 26,305 points and the neckline of the complex head and shoulders top pattern. After completing this pullback, the index is expected to continue its downward movement with the next support level at 25,550 points. U.S. President Donald Trump stated that if necessary, the U.S. Navy will escort oil tankers through the Strait of Hormuz, and the United States will ensure the smooth flow of energy supplies. Oil price gains subsequently narrowed. U.S. stocks performed like a roller coaster on Tuesday. The Dow Jones Industrial Average opened 411 points lower and at one point plunged as much as 1,277 points, or 2.6%, reaching a low of 47,626 points. The losses then gradually narrowed, and the index eventually closed down 403 points, or 0.8%, at 48,501 points. The S&P 500 index fell 64 points, or 0.9%, to close at 6,816 points. The Nasdaq Composite dropped as much as 624 points intraday, representing a decline of 2.7%, before finishing down 232 points, or 1%, at 22,516 points, making it the worst performer among the three major indexes. The Fixed Fear Index rose 2.13 points, or 9.93%, to 23.57 points. The Nasdaq China Golden Dragon Index, which reflects the performance of Chinese concept stocks, fell 240 points, or 3.3%, to close at 6,958 points. Among the Dow Jones components, Caterpillar fell 4%, while both Nike and Boeing declined more than 2% each. Within the Magnificent Seven stocks, Microsoft bucked the trend and rose more than 1%. In contrast, Tesla fell 3% for the day and was the weakest performer in the group. Alphabet and Nvidia each dropped about 1%. According to reports, U.S. officials are considering restricting Nvidia from exporting artificial intelligence chips to any Chinese company with a proposed cap of 75,000 units. Sources indicated that shipments of AMD's MI325 chips will also be counted toward customers' purchase limits, although Nvidia's total shipments to China could still reach 1 million units. Chip stocks saw significant declines, with Micron dropping 8% and Intel falling 5%. Apple announced the launch of its new MacBook laptop series. The 13-inch model starts at $8,999, while the 15-inch version starts at $9,999, with each customer limited to purchasing a maximum of 6 units of the 13-inch and 15-inch MacBook Air respectively. The MacBook Pro series equipped with the M5 Pro chip starts at $14,499. Pre-orders will begin at 10:15 p.m. Hong Kong time on Wednesday, March 4th, with shipments starting from March 11. U.S. retailer Target reported that its fourth quarter net profit for the period ended late January fell approximately 5% year-on-year to $1.05 billion. Adjusted earnings per share came in at $2.44, beating market expectations of $2.16. Quarterly revenue declined 1.5% to $30.45 billion, likely missing the expected $30.48 billion. Same-store sales fell 2.5% year-on-year. Foot traffic at both Target stores and its website has declined for 4 consecutive quarters. The company expects net sales for the current fiscal year to grow approximately 2% year-on-year, with quarterly growth throughout the year, and forecast full-year adjusted earnings per share between $7.5 and $8.5. Our stock pick today is China Longyuan Power, stock code 916. China Longyuan Power is vigorously promoting the new Energy Plus model to enhance its resource acquisition capabilities through large-scale development. In the first half of 2025, the group recorded a net increase of 2,053.54 megawatt in controlled new energy installed capacity. This comprised the net addition of 986.95 megawatt in wind power controlled capacity, 1,096.59 megawatt in solar power controlled capacity, and a reduction of 30 megawatt in biomass power controlled capacity. As at 30th June 2025, the group's total controlled installed capacity stood at 43,196.74 megawatt, of which wind power accounted for 31,395.72 megawatt, solar power 11,794.92 megawatt, and other renewable energy 6.1 megawatt. In the first half of 2025, the group generated a cumulative 39,652,477 megawatt hour of electricity. Wind power generation total 33,502,617 megawatt hour, representing a year-on-year increase of 6.07%. Solar power generation reached 6,146,915 megawatt hour, a substantial rise of 71.37%. In response to national major development strategies, the group is fully advancing desert, Gobi, and wilderness wind solar mega-base projects and strengthening offshore wind power expansion. It is prioritizing competitive allocation quotas in the central and southern regions with assured consumption and relatively attractive electricity prices. The group is implementing replace small with large projects, integrating rural revitalization to secure contiguous development, promoting shared energy storage projects tailored to local conditions, and orderly deploying green electricity to hydrogen ammonia projects aligned with downstream markets. It is also accelerating the layout of far offshore wind projects. In the first half of 2025, the group signed new development agreements for 1.24 gigawatt, all located in high-quality resource areas. It also obtained a cumulative 4.75 gigawatt of development quotas. Adhering to the philosophy of green development, the group maintains a centralized and unified management model for green certificates, leverages its scale advantage to enhance green electricity and green certificate marketing capabilities, and actively expands overseas green certificate sales. In the first half of 2025, it completed 4.14 billion kilowatt hour of green electricity trading, up 41.67% year-on-year, and traded 4.232 million green certificates, an increase of 81.46%. In addition, the group is actively implementing the Belt and Road Initiative. It focuses on 5 good countries, those with strong China relations, large market potential, favorable economic prospects, high national creditworthiness, and low investment risk, to advance international green energy cooperation. This includes deepening presence in Southern Africa, exploring markets in Central Asia and the Middle East, and studying opportunities in Latin America. In the first half of 2025, the group secured approval for 6 overseas new energy projects totaling 1.44 gigawatt. Suggested buy price 7.45 Hong Kong dollars, target price $8.25, stop loss $7.05. I do not hold the above stock.